So our next session, it's about overcoming challenges on measuring ESG within real assets. We have two speakers for this session. We have Karen Shackleton, Director of Pensions for Purpose, and we have Thomas Kanzi, Director of Vivid Economics. A reminder to everyone in the audience, please do use the chat function to submit any questions you'd like me to put to our panelists. This is a session with, I think you'll find out, so much scope for discussion and things to explore. I think I'm handing over first to Karen. I think you've got about 10 minutes to sort of set out your initial thoughts on this, please.
Thank you, and good afternoon, everybody, and thank you for hanging on in there to listen to the session at the end of the day. What I find interesting at the moment is that I think we are really beginning to see an emergence of a new normal in terms of investment thinking, and I find that really, really exciting. You've probably all heard me talk ad nauseum about the spectrum of capital, and I'm not going to talk about that today, but what I will say is that I think that there is gradually happening a shift across to more to the right-hand side of the spectrum of capital. So I don't think that the traditional style of investment, where you were purely focused on financial goals, is where we are at now. I think the default now that's emerging is responsible investment, where you take into account the risks associated with either environmental or social or governance issues. And that's really exciting because in turn it's sparking more and more interest in other strategies such as sustainable, more thematic approaches that benefit all stakeholders, and also towards impact investments that have this dual goal of achieving both a financial return and also having a positive impact on either society or the environment. And what's interesting is that that's actually being matched by a change in attitudes within companies. There was a survey out, I think it was earlier this week or the back end of last week, by the Institute of Directors, and they found that 60% of the respondents in the survey felt that their company goals should not be confined just to shareholders, that they actually should be taking in a wider remit of stakeholders in their objectives for their company. And 90% of them felt that their company should have a purpose or a mission or a sort of more non-financial goal. So there's some real changes emerging, and I think the pandemic has fueled that. It's made people think long and hard about what we are about, what we're here to do, and that's really exciting. So where does that leave pension funds? Well, I think many are beginning to articulate a set of investment beliefs, and we have been working with pension funds to help them do that. So many of them are using the Sustainable Development Goals as a framework for that discussion and coming up with a set of priorities of SDG goals that they want to focus on. And I'm a great believer in making sure that there's a very strong investment thesis underpinning that priority. So it's not just about doing good, it fits in very neatly with the fiduciary responsibilities. One thing that I would say is that there are an emerging number of different frameworks that are being targeted to asset owners to help them with their shift towards a more responsible ESG focused approach, and that can be confusing. There are quite a number of them out there, but actually if you unpick them, they're all broadly working towards the same thing. And I think that's interesting. So it's worth, even if you just choose one of them, it's worth comparing them with some of the others just to see where the differences are. But pension funds now, as I say, they're doing their work in terms of articulating a set of investment beliefs, establishing a set of priorities for their pension fund. And many of them now are at the stage of thinking about the investment strategy. And that in turn is leading to some changes in the underlying portfolio, and that presents challenges. So for example, how can they discern between an authentic green fund, for example, and a fund that is greenwashing and just sort of ticking the green boxes so that they can acquire money. And that can be even harder in the private markets, of course, because data is perhaps less readily available. And so it can be confusing for the investor who's trying to work out which are the authentic funds. And then once they've committed capital, what's going to be the best way for them to measure and monitor and challenge the asset manager on the impact criteria? So these are all things which are coming into play, and I find it quite interesting to see where we're going. I'm sure we'll cover off some of the sort of questions around measurement and challenge of asset managers a bit later in the session, but it's probably best if I stop there and hand over to Thomas.
Great, thank you, Karen, and hi everyone. Thank you very much also for bearing with us at the end of the day, pretty much. Sorry, there seems to be a bit of an echo. Oh, perfect, that's fine. Perfect. I wanted to talk a bit more about sort of a bit for you about the facets of responsible investment, what in a way the current focus is on ESG. Part of it, why measurement is so challenging, and then as well, what is the light on the horizon for many of these parts, and some broad considerations for asset owners. And so, yes, I mean, this is really all about the long-term plan for real assets. That's really what is behind this. How sustainable are they, and how responsible are they in the future? We have already some of those considerations very much reflected for climate. So we can, transition some of the things from dirty to clean. So coal to biomass, other things that need to be responsibly managed down. So, for example, considerations around selling oil fields to someone who not selling oil fields to someone who runs them harder in the end. And we need to create a new, really new overall investment channel for, in this case, greener investment and more socially responsible investment. But as you can already glean from this, a lot of the ESG focus has been, yes, indeed, on some of the social measures in terms of do no harm for this, to do no harm to people and also to provide livelihoods. So it has some positive, not only some no negative side on the social side, but really it has also become on climate. And that is really because it's easier to measure to some extent. And we have many smart people and organizations that have already thought through this, from the TCFD, the Task Force for Climate-Related Financial Disclosures, to the International Investor Group on Climate Change, to the Net Zero Asset Owner Alliance, to the scenarios providers that tell you where real assets are going. When we see this from the International Energy Agency, we ourselves do one with the Inevitable Policy Response, and many others. So there is, in a way, good forward guidance available of what is happening on the climate side. Yet still, even there, the measurement has been difficult, and that gets even more difficult once we move to the other dimensions within E, in the social as well as the governance side of it. And so what it really is that the measurement itself is challenging. And so for the other parts in E, S, and G, it doesn't really mean that these are less relevant. It's just that they've really been harder to measure, and we're just now starting to make focus on putting them back into focus. So when we're thinking of the Task Force for nature-related financial disclosures, for efforts on biodiversity and various other ones, and these are really just emerging. And what still holds at the moment is that to some extent one can go ESG rating shopping, and I think the Financial Times made that point. If you wanted to show that a company in question has been performing very well along the ESG dimension, you pick this rating. And vice versa. If you want to show that it hasn't been doing well, you should pick another rating, because they've been sort of all over the place. And so we do need better disclosures that are more relevant, more timely, and broader. So that's one of the things that is slowly coming along the ES and G dimensions, and we'll mention a couple of the tools for this as well. Now, beyond just measuring, it has also been very difficult to quantify financial impacts. How much value is at risk and how much is created in the end? And that's really also the crux of ESG metrics, how relevant they are. Because if we're just measuring something for the sake of measuring it, what's the point in the end? If it doesn't tell you anything about the returns, the risk profile, and the long-term development of it. And so on climate, we're cracking this nuts, and we really get good indicators for transition and physical risk. We have the taxonomies of what is green investment, and we have the forward guidance from the scenarios. So there's lots out there for asset owners to ask the right questions in the end, and really for strategic asset allocation, do the necessary capital recycling from dirty to clean in a way. Now, that itself is available by itself, but working with many people in this area, we're only really just about to incorporate this more broadly into investment decisions. And there's still some ways to go, right? I mean, when you look at the Net Zero Asset Owner Alliance, these are some of the heavyweights, and they're just themselves working through what the right guidance for this is, as well as how we incorporate this entirely into investment decisions. And that is on climate, as I said, that is a bit more advanced. And so correspondingly, this remains even further off for other ESG dimensions. And so we get better frameworks, and we will see more coming. And now it's basically all about the preparation for this, because we're seeing this reshuffling already happening. So people pay very much attention to anything on the social side, on the environmental side as well. We're sort of reallocating capital. So there's many things to watch out for, and I think we go a bit more into this in the Q&A. Last but not least, I also just wanted to make a broader point about what this broader capital reallocation means. This is really has implications on the overall systems level as well as for cash flow, which is important in the end for asset owners. A lot of the good ESG investment, and a lot of particularly the green climate investment, is capital intensive. So that itself isn't so bad in a quote unquote capital rich environment right now. But when we model some of the macroeconomic impacts of this, and most macroeconomics models show this, this can drive up inflation in the short term before any of the deflationary effects in the future kick in from reduced energy costs, etc. Now, this is also now becoming more and more the focus as the effects of the COVID-19 stimulus packages and continued stimulus packages play through. They really start to show in macroeconomic variables, and I think everyone read all the implications of rising inflation, etc. for this. And what's even worse is that the stimuli were not very green many times in the first place, so they kind of doubled down a bit on the climate risk often part. Now, the second part, that not only is there some broader consideration about inflation, but many of the greener investments oftentimes have a lower cash flow profile in the beginning. So they're very capital intensive, and then they slowly pay off over time. Now, that, of course, opens it up where moving away from some of the reliable dividend payers, particularly fossil fuel companies, and more towards greener. So what is essentially, the question for us becomes how much and how fast can we wean off hydrocarbon dividends and start replacing those with green returns. And so again, I think that's something we dive deeper as well in the Q&A itself, but it has implication for asset owners, and particularly investing in real assets, on how quickly we turn over on this. So yeah, thank you. As I said, like the measuring is a challenge, remains a challenge. I think more is coming, particularly taxonomies, but it would also be great to understand in the questions that you have on how restrictive some of the taxonomies can be as well, because they're a taxonomy after all, so they tell you what is allowed and what isn't allowed to some extent. So thank you.
Great, thank you very much, Thomas and Karen. I think that sets the scene really usefully. I'll kick off with a couple of questions to sort of get the conversation going, I guess. And there's an issue of, after you've committed the capital, how can an LGPS fund measure the success on impact criteria in real assets and really ensure the continued improvement towards those impact goals? I know there's one that perhaps Karen wants to start off on, then I'll come to Thomas.
Sure. I'm a big fan of having a set of terms of reference for assessing investments and managers. And historically, those have typically focused on the financial criteria, the expectations of what it will deliver in terms of risk and return. They probably had some expectations over key man risks and sort of a trigger that comes about if somebody's going to leave the firm, for example, especially if it's the fund manager or the CIO, for example. And it will probably have some criteria around changes in the investment process, because you want to be sure that what you have invested in remains, what the process remains throughout your investment. But what's interesting is that now we've got to bring purpose and impact and environmental and social issues into those terms of reference. And it's worth spending time thinking about how best to assess that. I think it is worth as well, I mean, managers are increasingly presenting more and more data to evidence the impact that they're having on their underlying investments, and that's all very well and good. But what I haven't seen so much of so far is comparison over time of those statistics. And I think it would be wise for pension funds to sort of push their managers to report their statistics historically, as well as presenting the current data, so that you can see that evidence of improvement over time. And then last of all, don't forget the narrative, because that's where some of the impact on these underlying investments can absolutely come alive. And it's interesting, and you realize that, gosh, we are making a difference to people's lives here. So it's actually a really fascinating way of finding out more about the impact that your investments are achieving. So don't forget about that, because the qualitative descriptions are important as well.
Thomas, I saw you nodding at various points there. Do you sort of generally agree with Karen there, or have any sort of other thoughts around this? 'Cause it's a pretty key question once people have made that commitment.
Yeah, no, so I fully agree with Karen. Excellent points. And it's just a bit of a reminder that in the end, you're the asset owners, and you can decide, and you can put the mandate down, essentially. And you can say, hey, we want to see this, we want to see that, we want to have this incorporated, we want to have that incorporated. And you can start selecting people on those criteria. So it's to some extent, your mandate comes in the end from, well, the people to a large extent. And so they want that, essentially. And now it's to some extent on the asset owners to say, this is what we want to do. And we've seen this on climate. We will see this on wider environmental factors. We've seen it on social already. We'll see the same thing on governments, or we have seen it on governments to a large extent already. And so, yeah, so fully agree with Karen. It's all about making sure that we have those right questions, we ask those questions, and we track them over time, and distinguish them by performance. Because in the end, measurement is only good when you actually manage it afterwards. And so this is also then the selection process of asset managers.
I mean, I think following on from that, do either of you have examples of best practice you've seen for impact reporting? Ways that within the LGPS or elsewhere this has been done successfully, models that other people could look to, ideas that you see being developed that you think will really answer some of these challenges that we've been discussing so far. Thomas, I'll come to you first with this one, then pop over to Karen afterwards.
Yeah, sure. It gets hard because I think many organizations do some part of it very right, and I wouldn't necessarily be able to single out like one best practice example. I think many people get part of it right, so it's a bit of a mix and match approach, and then similar, it becomes a bit idiosyncratic to your individual circumstances of what is actually good practice for you. Not even to speak of best practice, because we're still, I think, from the implementation, we're still away from best practice just because we're still limited on what information is available. So you kind of build up with good practice over time. And I know that it would be nice to say like, hey, just look at these folks and copy them to a large extent. But maybe Karen, you have one of the examples, but it's a bit more of a mix and match approach.
Yep, Karen.
It's funny you should, sorry.
Go ahead, sorry.
So it's funny that you should say, mix and match approach, Thomas, because I think I would have absolutely agreed with you until this week, because I was sent an impact report from a manager who had previously won one of our content awards for best in class. And then they didn't win it after that, and so they're really keen to win it again. And so they sent me their latest version for my thoughts, and it was actually really, really good. So what was it about it that I liked? Well, they made great use of graphics to convey the key points. And I mean, I'm not talking specifically about them here, I'm talking about sort of funds generally, but it's having evidence of, if it's a housing fund, the number of people who've been housed in the quarter, or if it's an environmental fund, how much CO2 has been avoided. So they really use their data effectively and in an eye-catching way. It was very well structured. They used themes, which I really liked. So they sort of followed through on different themes in the fund and talked about how they had improved their impact in those particular themes. And one thing that I've noticed with pension funds is that although many of them have embarked on purpose with an environmental lens, what happens is that as soon as they start talking about it, they start thinking about social lenses as well. And so the best impact reports definitely, if it's an environmental fund, it will talk about the environmental impact, but then they will also say about the impact they're having on the community and perhaps the initiatives that they've undertaken with the community and vice versa. And then the third thing that this particular report had, which I really liked, was some great case studies. They weren't too long, they were short, they were easy to digest, and they absolutely demonstrated the impact that the fund was claiming to be offering. So it doesn't have to be a long report. I think where many managers are perhaps going wrong is presenting too much data. And it doesn't have to be too long. It's about making sure that the main points absolutely stand out to the reader and mean that the investor can judge it effectively on an ongoing basis.
Now, I know the issue of greenwashing, it was raised earlier, and I guess when I hear case studies and graphics, you can easily see how those could be used for greenwashing purposes rather than giving a really thorough, objective overall picture. I mean, are there key tips when it comes to real assets and looking at measuring impact there, things that can avoid pension funds being taken in by greenwashing? Are there red flags that you'd think really should be a danger signal for investors? Thomas, shall I come to you first?
Yeah, sure. No, I mean, Karen, I like to see that report as well, because that sounds really good. And I think, Martin, exactly to that point, I'm sure that report as well tracks the overall performance. So it has all the data in the back of it. It's just not necessarily at the forefront. So I think people should be wary when there is only case studies, or here's a couple of our flagship projects, and the rest of it is kind of hidden. Then you know that it's a bit of cherry picking overall. I think in particular for real assets, it is about what the plans are for it and what has been the performance over time. Because then those two go in a way together. You can then provide that, well, you need to request that information, people need to provide that information to say, this is not only how we want to run this in the future on the overall environmental or social metrics. And I agree, Karen, environment always has to go with social in here, because otherwise it is not sustainable, essentially. So that plan is in there, and you have the announced plans, but then also the historic data in terms of what have we actually done over the last 3-5 years with those assets, and how did it stack up against our goals. It's perfectly fine sometimes to say nothing has happened over the past 5 years because, quite frankly, we didn't do anything about it. Now it's high time to do something. And then it is all about the targets and then the reporting framework, and very transparently saying we will report these metrics, and these are our KPIs that we will track, and we will report them together with Karen, as you highlighted. There might be some best practice floating around after all for this to make sure that people understand how it moved and the highlights of it.
Karen, I mean, are there sort of, again, red flags for you that might be a telltale sign of greenwashing when people report on their real assets, or things that we should be looking for to ensure we're getting real data, real feedback that we can actually make firm judgments on the basis of?
I mean, I think you need to be looking for additionality. You need to be seeing that something extra is being delivered over and above what would naturally be delivered through the investment in a non-intentional way. So that's something that I would be quizzing about. But as well, I mean, another thing that I mean, you know, I speak to a lot of managers in this space now, and you can really look in the whites of their eyes and tell whether they are authentic or not. And so I sort of asked myself, well, what is it about them that makes the difference? And I think that you can question the firm who is presenting to you about their ethics, and you know, sort of ask them about their mission, their values, and they should absolutely be aligned to the mission and the values of the underlying investment. But as well, it is still about having that balance between the desire to have a positive social or environmental impact, but also keeping your eye on the financials and recognizing that if you are going to be attracting a pension fund investor, you have to be delivering market rate risk adjusted returns as well. So it's that sort of awareness of both the financial and the impact criteria, and being robust when challenged on that, and making sure that the manager themselves is aligned.
Yeah, I think that's very helpful. Another thing that certainly when I'm reading up about this, I get blinded by the number of different terms, measures, acronyms in this field. If you're an investor, how do you cope with all this jargon? Are there key things that you really should be looking at? What's the advice here? What are the key terms and the way to navigate through them? Karen, I'll come back to you actually on that one if you don't mind.
Sure. I mean, it's a really interesting point, isn't it? And I mean, I'm on a learning curve here as well, like the next person. Recently, we did a training course in climate science basics, and it was basically trying to unpack some of the science that underpins this climate challenge that we're facing. And we sort of set everybody a little challenge as to who could ask the most stupid question. And of course, nobody won the award, because you can't actually ask a stupid question because everybody else is probably thinking the same thing. So I think it is about being inquisitive and not being afraid to say, actually, could you just explain that to me? And maybe the person you're speaking to doesn't explain it very well, so go and speak to somebody else and ask them to explain it. Yes, there's loads of jargon. We're in a jargon-filled industry, aren't we? So it's about picking people up, don't letting them use acronyms. And Thomas was very good at defining TCFD earlier. There are so many acronyms, aren't there? So keep quizzing, keep pushing, read up on the subject, and take time to understand it. And don't invest until you are comfortable that you have a level of understanding. You're not expected to be an expert, but that you have a level of understanding that allows you to make an informed decision. And of course, you know, rely on your advisors and consultants as well to feed into that, because they will have certainly been spending a lot of time learning about the new approaches that you're considering.
Certainly the sort of advice I had when I was training to be a journalist was, there are no stupid questions. Always ask if you don't understand something. It doesn't matter if you sound stupid. It's just the basics, isn't it, really? Thomas, did you want to add anything to that?
Yeah, just to quickly add, I would also go for the NGOs and broader organization in this place. So when you look at the principles for responsible investment, the Institutional Investor Group on climate change, and various other ones, they do a great job at not only defining the terms, but just by listening into this, it's also understanding the broader meaning, because just the glossary might not be as helpful as understanding, how has it come to this point and what are the next phases for this. And similarly, they and many others provide frameworks as well as questionnaires and various other things to kickstart it. Because I think even when you understand the term, then it's like, oh no, I need to come up with all the questions that I need to ask other people as well. And they have great jumping points for this. We have full lists, and you can just run with that to some extent, and it covers the basics. Or you can use that to build off and design your own questionnaires, or your own line of inquisition, basically, for various other people.
No, good advice there. Something when we were preparing for this session of the seminar, I know there's a question about sustainable development goals, which Karen, you talked about there, but the comparison of with listed assets. I mean, do you think real assets genuinely can align with the UN Sustainable Development Goals, or do the issues of data in real estate and the different ways that asset managers, you know, use their methodology, does that make this less reliable? I mean, how good are the SDGs when it comes to real assets? Karen, I'll throw that one straight to you.
Well, I mean, it's undoubtedly harder to do because of the data challenge of finding out the sort of information that you need to be able to align to the SDGs. But we did some research, gosh, it must be 2 summers ago now, looking at firms who were mapping portfolios to the Sustainable Development Goals. And what was interesting was that whereas everybody said that they could map listed equities, only 40% could measure SDG alignment in real assets. So it is definitely harder to do. What I would say is that if you are being presented with SDG alignment data from real asset managers, do ask about the percentage of coverage, because actually if you challenge them, sometimes there's quite a big percentage of the portfolio that just hasn't been analysed because it's too difficult, they just couldn't get the data. But then it is presented as if it is on the whole portfolio. So that's definitely something to challenge them on. And then also do drill down to understand how the asset manager has measured their SDG alignment. So different firms do it different ways. So for example, have they excluded certain sustainable development goals, or do they map to them all? Do they measure positive impact only, or do they incorporate the fact that some of their investments will have both positive and negative impact, and so they sort of measure the net impact? And how do they treat things like scope 1, 2 and 3 emissions? Are they including all of them, or are they just focusing on scope 1 and 2? So I would say that even in the listed market, impact measurement is evolving. And so the real assets market is sort of even further behind, really. It's still an evolving space, but it's not impossible to do. And, I have seen firms do it very, very effectively. And it can be a useful way of comparing one manager against another, because you have got this sort of common alignment process that you're using to assess impact.
I wonder, Thomas, how useful you thought the Sustainable Development Goals are, when it comes to real assets specifically. I mean, do the challenges mean we're not quite there yet, or are they useful as things stand, and we should be asking about them more, challenging more on that basis?
Yeah, no, it's the latter. It's that I definitely think the Sustainable Development Goals are useful. And we're just lacking in achieving some of them. And real assets play a big role in this in the end. Picking up from Karen's point, it's not only the mapping of it afterwards. Karen already raised all the methodologies around it and etc. But then it is also about how good is it actually measured and how much is achieved afterwards. Because it's easy to say like, hey, we provide some sustainable livelihoods, or we do something that changes X, Y, Z, without putting a concrete number against it. And that goes back to the reporting part of it. It's nice to say, hey, we ticked all of those SDGs, but what do we actually achieve, and what do we aim to achieve over time? And that gets a bit harder for real assets, because one, it is lagging to some extent, and two, many of them are already in place. So it also becomes a bit more about what is the transition of some of those real assets in the future, where nothing might happen for quite a while, and then we sort of flip it over and it touches more of the SDGs.
Fantastic. Now, I'm conscious we're coming towards the end of the session here, but I didn't want to lose the opportunity for either of you to make any sort of concluding remarks or sort of wrap up. If there's a single message you think people worried about your measurement in this area could perhaps take away from this session, one piece of advice, one resource you think that they could go to really find out more and clarify their thinking here. I wondered if you had any final message there. Karen, I'll give you the first opportunity, in brief if possible, but please, I'll throw that one to you.
I think, what would my advice be? So I think it's about going on the journey, and don't be put off by the fact that, you know, we're not in a perfect world yet in terms of impact assessment, impact measurement. So do go on the journey and start small, learn, and then you will become much more discerning over time and more demanding of the data that you require. And certainly some of the pension funds that I've worked with, they have absolutely done this, and they've become more insistent on what they want from their asset managers in terms of evidencing the impact that they've achieved. The other thing I would say is that do look at the full universe, and there are many sort of niche managers who are doing incredibly good work, especially in the unlisted space, in the private market space. So don't just be, I just don't feel it's the same as the traditional way of saying, right, we want a 3-year track record and we're looking for a large firm. Because actually some of the more interesting opportunities are with smaller boutique firms who've actually been doing this kind of investment for 10, 15 years, and they're definitely worth a look. So I think you said not to be too long, Martin, so I think I'll probably just sort of leave it there and give time for Thomas.
Well, Thomas, I think you must be in a lot of agreement there, judging by your nodding there. But I mean, concluding thoughts from yourself on this.
Yeah, no, I mean, it's for me, it's about setting smart goals essentially, and just saying, hey, this is the stuff that we want to have measured. This is an achievable level that you can get it to, and I would like to have that measurement over the next, within the next 1, 2, 3 years, whatever it is. Setting yourself that target and then doing the selection on the basis of that. Because then you pick up some of the disruptives, the smaller funds that basically do all of this already, but don't necessarily tick some of the other criteria because the large ones might be sluggish to move. And you can give an incentive to the ones that are sluggish to move to actually shape up their game essentially and provide you with the relevant information. So it's to some extent setting smart goals and quite frankly being a bit demanding on this.
Fantastic. Well, inevitably, time is always our enemy at these events. There's so much more we could discuss in this area, but I'd like to thank Karen, Thomas. That's been fantastic. I think people will take away an awful lot of really useful things as they go forward in this space.